Welcome to Educational Alpha. I'm Bill Kelly, CEO of Chi Association, and your host, bringing you on-the-ground conversations with business leaders, educators, and industry colleagues from around the globe. Educational Alpha is sponsored by iCapital, the financial technology company with the mission to power the world's alternative investment marketplace. Part innovator, part educator, and part navigator of the alternatives industry, iCapital offers intuitive, scalable digital solutions that have transformed how private market and hedge fund investments are bought and sold. With iCapital, financial advisors, wealth managers, and asset managers around the world now have access to everything they need to deliver the return and diversification potential of alternatives to high net worth investors. To learn more, visit iCapital.com.
In this episode, Bill is joined by author Jared Dillian, discussing his journey from a radio show host to an accomplished author. They explore themes of financial stress and risk management, delving into Jared's philosophy of living a stress-free financial life. The conversation touches upon Jared's views on ambition, his diverse career including a stint as a DJ, and his future literary endeavors. Listen in.
Jared Dillian, welcome to Educational Alpha.
Hey, Bill, thanks for having me.
My pleasure. So we first met at Kaya event, which was our launch in Charlotte, I guess now just a few months ago. It was the latter part of 2023. And I knew a little about you, but it was an interesting discussion. And you're an author, I think, soon, ×4. You can correct me on that.
Yep.
And we're going to talk about Those Bastards, which is the book you had with you. And it's a compilation of what I would describe as 69 short stories. I read it myself on the flight back to Boston after we met. I found it very interesting, and I thought I was just helping you out with $20, but I learned quite a bit and a few things I wanted to talk about there too. But you've got a very, very different background and set of experiences, and I think there's a chapter of the Coast Guard and the service discipline, a trader, an author, a DJ, you've got your MFA, which is kind of unusual in our space. So maybe just introduce who Jared is and we'll take it from there.
Yeah. Out of high school, I went to the Coast Guard Academy, mostly because I didn't have money to go to college. Majored in math and graduated, spent 5 years in the Coast Guard. I did a couple years at sea on a Coast Guard cutter, and then I did 3 years doing intelligence. While I was in the Coast Guard, I got my MBA part-time from the University of San Francisco, which was a great education. It's not a well-known school for business programs, but it was a great education. I also got a part-time job on the Pacific Options Exchange. That was my first exposure to capital markets. And then I got hired by Lehman Brothers in New York in their MBA program, the associate program. That was in 2001. And I stayed at Lehman for 7 years. I did index arbitrage first, and then I was the head of ETF trading. I had a great career at Lehman. Wish it would have lasted longer, but you know what happened. Then I started my newsletter, the Daily Dirtnap, after the bankruptcy. I started that in 2008. I've been doing that for 15 plus years. Written 4 books, as you said, Street Freak in 2011, All the Evil of This World in 2016, Those Bastards last year, and in a week, we have No Worries, How to Live a Stress-Free Financial Life. I had a radio show for 2 years from 19 to 21. I've been an op-ed columnist at Bloomberg for 5.5 years, written for some other places. And yeah, I do music in my spare time. I'm a DJ.
So a very interesting, eclectic, and diversified portfolio of stuff. Have you found yourself yet, or is there a 5th or 6th chapter?
Well, the MFA, I think, was midlife crisis number 4. I also forgot to mention I got a master's in fine arts and creative writing from Savannah College of Art and Design. And I did that late in life. I just graduated last June.
Yeah, congratulations on being a lifelong learner, and your curiosity about what's around the corner speaks for itself. So, as I said, having read some of these essays in Those Bastards, there were a few different things that struck me. And I've got 5 kids, and I told them about the book because I think these lessons can be taken in, learned, and maybe modeled by people of a lot of different age groups. But There are a couple of themes I want to focus on. One, I forget if the name of the chapter is ambition, but you talk about the importance of ambition. And I think you liken it to success is like an iceberg, and you can't really see all the work beneath the surface. And life is full of setbacks. It's not always on the positive side. And ambition is probably something that is perpetual as opposed to ambitious today, less ambitious tomorrow. But that seemed to be, I've read that chapter, but it seems to bleed into other views and opinions you have. And I don't know if that's the most important attribute that should define a person, but maybe I'll let you run with that about your views and ambition and what direction you want to take it.
Yeah, I mean, I'm a big thinker. I think big. I like to think big and achieve big. One of my favorite quotes is, after 25 years, he was an overnight success. Let's pretend like No Worries turns into like this runaway bestseller and I sell 1 million copies and it goes crazy. People are going to be like, oh, this Jared Dillian guy is new. I'd never heard of him before. Like, he just got lucky with this book. But what people don't see is literally the tens of thousands of hours of writing that goes into a writing career that leads to a book like this. So I'm working on another project. I can't talk about it right now, but I can tell you offline what I'm working on doing. Like I said, I like to think big and do really big stuff.
And you've done it well. Before I leave those bastards, there was another chapter in there where you talk about mental illness, and you've been disarmingly open about this, about some of the struggles in the world, some of your personal struggles. And I'm going to have a guest on in another couple of weeks who is a facilitator in a high school just outside of Boston. And the level of mental illness in society today is really off the charts. And one of the ways you describe this is you say it's not a handicap, but a blessing. And I thought that was a remarkably interesting way to think about it. So maybe some of your views on what I think is a societal issue that I think is affecting current and future economies. And we've got to find some ways of coming to grips with it and then figuring out what we're going to do about it.
Yeah, so I was diagnosed with bipolar disorder in 2006. There's two types of bipolar disorder. There's 1 and 2. I have 1 that's the more severe kind. Just for perspective, there's about 2 million people in the country with bipolar 2, and there's only 200,000 with bipolar 1. It's exceptionally severe, and it is a handicap in a lot of ways. A mental illness doesn't usually result in happy endings or success stories. A lot of people don't really come to terms with it. They never fully accept the fact that they have it, and they struggle in life. And for a lot of people, it leads to jails or institutions or death. I mean, those are the 3 most likely outcomes for people who are severely mentally ill. When I'm walking in New York and I see a mentally ill person on the street looking through trash or stuff like that, my thoughts around that is, in another capacity, that could be me. That could absolutely be me if I didn't get the incredible treatment that I received when I was hospitalized. I was at one of the best hospitals in the world. So I'm very gentle with people when it comes to stuff. And also, if you ever find yourself getting angry at somebody, like somebody's not behaving in a way that you like, 60% of the time, it's because of a substance abuse problem. 30% of the time, it's because of mental illness. And only 10% of the time, it's because they're a jerk. There's usually something going on in their lives that's causing them to behave that way. So I haven't done this in a while, but for a few years, I was on a pretty regular speaking circuit. I was speaking at banks and brokers about mental illness in the financial industry and stuff like that. And the most common types of mental illness that people experience in our world are anxiety and depression, just plain vanilla anxiety and depression. And the financial industry is an industry that creates a lot of anxiety, no matter what role you're in. I mean, if you're a trader, that's pretty obvious, trade sales and trading. But also if you're a research analyst, if you're a PM, if you're a banker, if you're accountable to anybody for any kind of calls, it's a very stress-inducing job. It's also the kind of job where you're sitting at a desk, you're not getting a lot of fresh air, and it can lead to depression, especially living in New York where there's not a lot of sunlight and stuff like that. So people deal with anxiety and depression all the time. So that's some of the stuff I talk about when I talk to people.
And I think step one is to get this out of the basement. It's nothing to be ashamed of or embarrassed about. It's something that should be looked at, examined. good help should be gotten when it could be gotten, and that should be open up to the masses. And I think part of the problem we have with some of these cities like New York and maybe to a greater degree San Francisco is how do we get help, not for the homeless, but for the mental illness that's on the street? And we're not going to solve for that on this podcast, but thank you for being so open, honest, and sincere about that. I think that's step one to perhaps solving the problem. So maybe taking anxiety as a segue to the capital markets today, and even for the most sane, and I don't know if there are many people that I would put in that category in this industry, this is a very trying time in the marketplace. You've got inflation, recession, central banks that are not sure what they're doing, an election here in the US that has a lot of fear attached to it, no matter which side of the aisle you're on, and then globally geopolitical risk. And earlier in 2023, it was all Russia's invasion of Ukraine. But now we have Hamas, we have what's going on in the Red Sea and China, Taiwan, and the list goes on and on. How do you think about geopolitical risk? It's not something that you or I faced or thought about much in the early days of our career, but it's now right in front of us. And that's coming in the wake of a whole lot of other garden variety risks about, as I said, inflation, recession, et cetera. So how do you think about this as an investor and as a commentator on the capital markets?
Geopolitical risk, for the most part, doesn't really matter. If there's not some nexus to what's going on with U.S. capital markets, it can be fear-inducing, it can be anxiety-inducing, but it doesn't necessarily matter for equity valuation or anything else. The only time it starts to matter is when the geopolitics becomes serious enough that it affects something like Fed policy or something like that. If there were global spillover effects from the war in Ukraine that caused the Fed to either hike or cut rates, then it matters. And maybe in the case of Ukraine, that actually did happen because it caused a lot of inflation in supply chains and maybe perhaps caused the Fed to raise rates more than they otherwise would have. And that was more of a subtle manifestation of it. I publish this newsletter, I publish a daily Dirtnap, and I write about markets every day. And I probably spend less than 1% of the time talking about geopolitical stuff. It's one of those things in markets that it matters when it matters. Until then, it just doesn't matter.
Well, it's a very difficult thing to model, as you say, unless this is an ongoing contagion like another world war. These things either solve themselves or the world moves on. And there's a lot less pleasant to think about it, but Russia and Ukraine, that's sort of moved out into the periphery and we've got other things to worry about. But collectively, I think people shrug their shoulders and say in the medium to longer term, it doesn't matter at all. Not so much an outlook per se, Jared, but in terms of your writings, and we're all long-term investors, so I'm not necessarily going after where the all-country world index of the S&P 500 is going to finish up in 2024. But the last 2 years are kind of interesting. 2022 is a year everybody would have loved to forget. The bond and equity markets correlated to a very large degree. And if you were in the traditional 60-40, you got scorched and got no benefit for diversification. And the equity markets drew down 20. And then quite the opposite happened last year where the all country world index was up 22. So quite a bit of volatility in between as well. So as you think about a medium to longer term outlook, and I'll leave you to define that. I don't mean tomorrow or next quarter. How are you feeling about valuations, and entry or exit points in the markets?
Well, valuations are high, but they've been high for a while, and that doesn't always matter. We're talking long term here, but stocks are overpriced here. I'm actually short at the moment. I added to the short before we got on the podcast. So I'm a little bit bearish on stocks. And I also, this correction that we've had in rates we basically went from the 5 handle to the 3 handle in 10. So I think interest rates have sort of bottomed for now. We got the comments out of Waller this morning saying that there's no need to rush rate cuts. So I think we've reached sort of a near-term floor in rates. I know you wanted to talk about the Awesome portfolio. I'm going to preempt that a little bit because you talked about how diversification, at least between stocks and bonds in 2022, didn't work. And that's kind of my core thesis is that if you have a 60-40 portfolio or an 80-20 portfolio or something like that, you are not diversified. And a lot of people, the first thing they do is they say, okay, I'm going to own the S&P 500. I have 500 stocks and therefore I'm diversified. No, if you have the S&P 500, you're not diversified. Then they say, well, I'm going to add some bonds to that. Okay, well, stocks and bonds are both financial assets, and you can look back in time, and sometimes they're negatively correlated and sometimes they're positively correlated. Most recently, they were positively correlated, so that diversification didn't work. You have to diversify out of financial assets into harder real assets, such as real estate and commodities and gold and stuff like that. So the Awesome Portfolio is something that I built, I think back in 2019, and it's 20% stocks, bonds, gold, cash, and real estate. The funny thing is that when you start adding gold and real estate to the portfolio, they're very uncorrelated, and it really brings down portfolio risk a lot. So just for example, the return of the S&P 500 averages around 9%. The Awesome Portfolio has historically returned 8% over time, but with half the risk of an 80-20 portfolio. And in terms of drawdowns, the max drawdown in any given year has been 12% for the Awesome Portfolio. So when I think about investing today, the conventional wisdom for retail investors is just put it all in stocks and ride out the volatility. Even if you had the ability to do that, like let's say you could ride out the volatility, you would be miserable. You would be absolutely miserable because every 3 or 4 years, you'd have a massive bear market and it would cause you all this stress and it wouldn't be a lot of fun. So you can trade away 1% in returns and cut your volatility in half. And that is the solution.
A couple of follow-ups. So how often do you rebalance?
Once a year.
So at the end of the year, no mid-year, so it's January 1, 2020, 2025 assets evenly weighted, keep that and rebalance 12/31?
Yep.
And you mentioned the S&P, and I agree, a cap-weighted index, and you probably own 7 stocks as opposed to 500. What is the equity proxy in the Awesome Portfolio? Is it okay if with a 20% exposure to use the S&P, or do you have a better proxy?
I actually use the VTI, the Total Stock Market Index. It gives you some small cap too. So I've been using the VTI when I back tested it.
Okay. And then real estate, is it an ETF exposure, REITs?
So yes and no. So the way you can do it is you can use the equity in your home as your real estate exposure. So if you have $1 million house and you have $400,000 in equity, and you have a $2 million Awesome Portfolio, that can be your real estate exposure. Or if you don't own any real estate, you can buy the one I recommend in the book is VNQ, the Vanguard REIT ETF, and that accomplishes the same thing.
And then gold is interesting, and I want to talk about how you access that, but then I also want to talk about in light of the SEC, and I don't know when this is going to air, but this is today, the 16th, and just last Thursday or Friday, the SEC for the first time approved the spot Bitcoin ETF. I think there are 11, maybe before the sun sets, we'll have more than that today, but the gate is open for this. And there are people that say that Bitcoin is digital gold. So I don't want to necessarily get into debate if that's true or not, but gold is the proxy today. Could it be another commodity? Could it be Bitcoin? And then maybe we can follow on with some of your views about a spot Bitcoin ETF. You were once in that business, maybe less so today.
Yeah, I mean, I think you can make the case for taking a tenth of your gold exposure and putting that in Bitcoin. So having 18% gold and 2% Bitcoin, I think that's okay. The big thing that the spot Bitcoin ETF does is it allows people to put this in their IRAs. That wasn't possible before. And now I can take any one of the Bitcoin ETFs, put them in my IRAs, dollar cost average into that, and hold it over time. Bitcoin actually dumped after the spot ETFs launched. And a lot of people said, well, it was a failure and stuff like that. But I have a feeling that the flows going into these ETFs are going to dwarf what goes into the actual cryptocurrency over time. And yeah, I think that'll probably work.
The ETF markets probably changed a lot. If you left Lehman, when Lehman left the world, that's going back about well over a dozen years, maybe 15, 16 years. I don't know what the ETF market was back then. Maybe it was 2 or 3 trillion. It's now 10. There's probably 9 to 10,000 offerings. Do we have too much choice out there? And is it confusing to either the reader of some of your publications, newsletters? Is it confusing just to the general public? And maybe there's not much we can do about it, but it is a very long shopping list. And probably a lot of these options are probably more correlated than not. And I always maintain, maybe back to the Awesome Portfolio, to the extent that you can get yourself or your client access to inexpensive, uncorrelated beta, that in and of itself is a massive, massive win.
Yeah. Is there too much choice? When I was a ETF trader, when I started, there were 250 ETFs. And in 2008, there were 600 ETFs. And now there's thousands. And it takes some skill to navigate that. There's ETF screeners that you can get online and stuff like that. But there's, like you said, there's a bewildering amount of options. I've kind of lost track of all the ETFs out there. I will say that the launches have slowed down and sort of the available real estate for good products has kind of gradually disappeared. And also some funds are closing. Some funds haven't been able to gather assets and they are closing. So there are births and deaths in the industry. And I don't think we're going to get to a point where we have 50,000 products. I think we're probably going to stay stable around here. But I think assets will continue to grow. We'll probably go over 10 billion, trillion.
And have you given any recent thought to the balance between ETF and 40 Act mutual funds? And you think about the tax efficiency, the ability to do intraday trading with an ETF, it's got some benefits, but the demise of the 40 Act mutual fund and that obituary has been written many, many times over for many, many years. And it's a space that has a lot of durability. Do you have any views about what the future of commingled funds might look like?
I actually like 40 Act funds better than ETFs for behavioral reasons. I mean, you mentioned the ability to trade intraday as sort of a benefit. I look at it as sort of a fault. If you're a retail investor and you're investing long term, if you have this asset that reprices only once per day, the only time you're going to look at it is when you get your quarterly statement. You're not going to look at it every day. But if you have an ETF and it has a ticker and it's in the stocks page on your phone, you're going to be watching it all the time. And I have a theory about information when it comes to investing. And I think that more information is actually worse than less information. The more data you're getting on price on your investments is actually going to lead to bad decisions. So for long-term investing, I much prefer 40 Act funds. Like you said, the obituary has been written and I really wish, I was an ETF trader and I was part of that whole revolution, but it's had some unintended consequences.
I'm with you on all those points. And if I think about democratization, which we don't have to get into today, I think we talked a little bit about that when we were together in Charlotte. But if we're going to give the investor more choice, if we can only teach them one thing, it's to buy and hold for a long time. And in the 40 Act space, and I've used this stat on this platform before, Morningstar did a 10-year rolling average, the delta between how the fund did versus the average investor. And in every case, they were giving up, in some cases, hundreds of basis points because they're tacking in and out. Where they did better than the fund itself was in the target date fund space because it's in the 401k. They don't have a lot of information. They don't have access to forget passwords, et cetera. And that money has actually performed better than any asset that the average retail investor has held. And I think, right to your theory, the less sophisticated you are, that more information it's not even less good, it's horrible because they think they can do something with it. And even the smartest investors, the Warren Buffetts and Howard Marks of the world, they will tell you that they themselves are the worst market timers. So for you and I to think we could do better than them is just patently absurd.
Yeah, agree with all that. Yeah.
So Jared, in the remaining time, I want to talk maybe a little bit about the chapter of Jared Dillian, the author. And maybe not so much, we talked about those bastards and life at Lehman. That's all been pretty well covered and documented. But this new book, it's coming out next week. So by the time this airs, it'll be live and well and hopefully on the Amazon bestseller list. And I'm happy to put a link in. But maybe talk about what you were trying to accomplish, because certainly I like the heading. I think the older in life you get, the less worries you should have. But I can tell you, even approaching my mid-60s, I think about, if I'm fortunate, 40 more years of living in front of me. And these should be great days, but you do think about the markets and what that'll do to the money you've saved and what it's going to do to your kids' fortunes, et cetera. But being able to live with no worries, that is the ultimate awesome life, awesome portfolio. So maybe a little bit about the book, the thesis, and what you're looking to accomplish here.
Yeah, back in 2018, I started getting interested in personal finance, and I started noticing that the big players in personal finance, like Dave Ramsey and Susie Orman and Robert Kiyosaki, just said incredibly stupid things all the time. Stuff that doesn't make any sense, like cut up all your credit cards and just live off the grid and pay cash, or never buy coffee, only make your coffee at home, and just all this stupid nonsense. So I'm like, there's got to be a smarter way to do this. So I started a radio show on personal finance, and it wasn't a big radio show. I was on like 40 stations, and it was a call-in show. People could call in. A lot of times I didn't get calls, and I was literally on a microphone just talking to myself. But I started to develop ideas, and the theme that I kept coming back to was this idea of financial stress. My philosophy is the goal isn't to make an infinity amount of money. The goal is to live a stress-free financial life. And the two sources of financial stress are debt and risk. So if you can minimize your debt and minimize your risk, then you will live a stress-free financial life. And that's really all there is to it. I talk about a bunch of other stuff in the book. I sort of get granular and I dig down into the different kinds of debt, mortgages and car loans and student loans and stuff like that. And in the risk part, I talk about the awesome portfolio because that is how you minimize your financial stress.
And I think in addition, I agree with you, debt and risk. Assets come with responsibilities too. And I think particularly on the tail end of the baby boomers, these big houses we've accumulated, the tax bill alone, just maintaining these is just enormous. And I guess maybe that's sort of a quasi debt payment as well. But I do think about who is going to be the liquidity mechanism for all of this stuff. And we've got, last I saw from Cerulli, 80 some odd $80 trillion of asset transfers from the baby boomer generation downstream. And some of that will be stocks and bonds, but some of it's going to be art, maybe cryptocurrency, big houses, and it's going to be a very busy liquidity window. I just hope it remains open and the market clears and the bid-ask spread doesn't get too wide. But would you throw just the cost of maintenance of some of these assets on that worry list as well?
Yeah. I mean, getting back to the idea of the baby boomers retiring, if you think about what should theoretically happen with that, the baby boomers are the largest holders of stocks and bonds. And as they retire, they should be liquidating those assets. They should be dis-saving, and that money should be going towards consumption. I read something somewhere that this should peak around 2026. Like I read some study, the author said that basically financial market, just based on demographics, should peak in 2026 just because of this dis-saving.
So then ultimately, just to put some round numbers on this, I think I checked recently and the market cap for U.S. equities is somewhere about 46 trillion. And Cerulli pegs its wealth transfer at about 2 times that. So if your thesis is correct, and it's hard to take the other side of that, if the baby boomers are coming out of the markets and moving into fixed income securities and planning around their retirement, what does this mean for the capital markets? Are they going to be in some kind of secular decline? Are they going to be shrinking? I'm not sure if this next generation, when they inherit, are going to be going into the S&P 500 or into a Bitcoin ETF or into something else. So is there a long-term scenario here that you can envision playing out or not?
Well, I think that we have begun one of these periods in the stock market. We've had them before from 1929 to 1945, 1969 to 1982. 2001 to 2011, where you basically had zero returns over a period of about a decade. And I think we're in the middle of that right now. I think we just started one of those periods. So what happens during those periods of time is that the underlying companies are unaffected. They continue to grow and make money, but valuations compress during that decade. So around 2030 or so, the S&P 500 will still be at 4,800, but stocks will be a lot cheaper. And that's kind of how I see this playing out. And you also get some big bear markets in between. So from 69 to 82, you had a big bear market in 74. So I think it's going to be a pretty tough 8 or 9 years for stocks.
Hence your reallocation right before you came on this show. So I totally get it. Jared, maybe I'll leave it there. Perhaps as you climb up the bestseller list, you'll remember me and I'll have you back on. Is there a fifth book in you now that you're a card-carrying MFA?
Yeah, actually, I have a book of short stories. It's done. This is fiction. These are actual short stories. And I'm looking to publish it either the end of 24 or the beginning of 25. It's called Night Moves.
Okay, well, I look forward to that. And I will tell the audience that, I did not know you until we met. I knew of you a little bit, but these 69 essays in those bastards, very interesting reads. And you've got a very witty style about you. I think the way you come across in a podcast, I think maybe hides a lot of that wit. It's probably stuck inside your pen when you're down in your basement scribbling away. But it is a very readable style. It's humorous, disarmingly honest. So thank you for all of that. I said, when this launches, I'm happy to put a link, and I look forward to not only reading it, but living a stress-free life in my remaining years on this planet.
Thanks, Bill.
Thank you, Jared. Thank you for listening to Educational Alpha. I'm your host, Bill Kelly. Learn more about the CHI Association and subscribe to the show at CHIA.org. That's CAIA.org. See you next time.